They say it's 5 o'clock somewhere, so good evening. My name is Akil and I'm going to be presenting my Bloomberg project for Finance 451. The purpose of this project was to evaluate companies and essentially pick the best one that we think should go into the portfolio. I picked companies from two industries. First, the biotech and pharmaceutical industry, and the second would be restaurants. As we get to take a look at these companies, what I did was I evaluated them and I picked the best one from each industry, and then I compared the best one from those industries against one another, and I picked the best company that I thought should be an investment made. So we'll go ahead and begin. For the first industry, biotech and pharmaceutical, these are the 5 companies that are part of a peer group that I chose. We have Gilead Sciences, Pfizer, Merck, Amgen, and AbbVie. These companies are very profitable, allegedly. We'll see. Industry analysis of biotech and pharmaceutical. Market capitalization is huge in this industry, $770 trillion worth. And looking at the 5 companies as far as what portion they're responsible for, they're just in over 5 trillion. Again, the industry revenue growth rate, 18,231% for biotech and pharmaceuticals, huge. I believe that is a 1-year average, that's a 1-year return for industry revenue growth. So looking at the 5 companies at 3.5%, they look very tiny. However, the industry is large and it's continuing to grow. Here we have our annual stock prices for all the 5 companies. Amgen is in the yellow, and they're sitting on top. They've had a significantly higher average stock price than all of the other companies. And Guild has made its way towards being an outlier. However, as of recent, they've kind of been within the pack of this peer group in particular. So on to some market data. We have current share price, we have the 5-year average share price, the year of their initial public offering, market capitalization, enterprise value, dividend yield, and then the beta. Again, as we saw in the previous graph, Amgen had a very high current share price. They have a very high 5-year average share price as well. I would consider them somewhat of an outlier to the peer group. Year of IPO, I put that in because I thought it would be significant in the sense that we really get to see, when you think about investments, you want to think short term, but you also want to think long term. And looking at the IPOs, we see 1992, 1972, 64, 2012, very fresh but also very old. So we have a nice mix for this peer group. And looking at the averages, we see for the 2 oldest companies, which would be Pfizer and Merck, their 5-year average price is sitting around the same or where they're currently trading. Their deviation is not very large as opposed to some of the younger companies. And so I think sometimes that can play as well a role in companies, in investments, and in firms who select companies to put in their portfolio. On to solvency management, which is a very important page, I believe. So the cash ratio I have here, I believe to be the most important short-term solvency ratio. It strips away anything that is not liquid enough to really be transferable or transferred into something liquid ASAP. This is literally just cash and cash equivalents. And as we see, Amgen is definitely, again, an outlier to the group. But everybody else is within a particular range. As of recent, they've all kind of been going down, so we get to see a trend in that. Obviously, these biotech and pharmaceutical companies they don't have as much cash on hand as they had at one point. However, it's not anything in the negative, and it's for the most part, most of them are over 50 cents. So you can expect them to have some debt, but it's not that bad. Looking at the debt to equity ratio, we get to see, well, for every dollar in equity that we have, how much do we have in debt? This is a really great ratio to see how levered a company is. Again, we'll see this later on, or at least a form of it with the equity multiplier. But this is a great ratio just to see and compare, how much debt do we have versus the amount of equity we have. And, the higher that is, that would mean the more levered you are in debt. So sometimes it's okay, but if you're, in a range like AbbVie here, you're not doing okay. You know, they obviously are swimming in money, but it's not their own. So they might have some problems coming up in the future, and that's something to be careful about. Looking at supply chain analysis, we have quite a bit of a difference here. The younger companies obviously don't have as many suppliers, and the story behind this, honestly, for Merck and Pfizer, they're larger companies. They're seasoned, as we saw in one of the previous slides. So they've had presidents within their industry. They own a lot of laboratories. They do a lot of experiments with a lot of different medicines. So they have a greater need for suppliers, as opposed to a company like Gilead, who they had the lowest amount of suppliers. However, their strategic management plans and goals don't necessarily always require for them to have a lot of suppliers, because they focus on a minimal amount of medicine products. What they do very well is they go out and they purchase or acquire other firms that are within their industry who may be seeking FDA approval, and they may inject cash into it. And again, with pharmaceutical companies, you know, the industry as a whole, once you find out that you have FDA approval, you have between 2 to 10 years of having no competition and reaping all rewards and revenues, which is why you see a lot and lots of advertisements for medicines all the time. I get tired of it. I don't even watch TV as much anymore because of it. So just thinking about that strategically, they don't have a lot of suppliers. However, that may not be their strategy, and we'll see later on. In a way, it really isn't, but it's worked out for them. Return on equity, so these numbers are actually a 5-year average from 2012 to 2016 fiscal years. So as we can see, for the group of them, a lot of them, they have a low total asset turnover, Gilead having the highest. But again, pharmaceuticals, sometimes it's not really a key driver for them. Equity multiplier, who is levered the most? You see everybody right up under 3, between 2 and 3, and then AbbVie out here is an outlier at 9, almost reaching 10. Operating margin, that yellow highlighter for Gilead Sciences, $54.10. So they're bringing home $54 for their shareholders versus everyone else within the group who's all under 40. So we can see that they're obviously going to have a high ROE, but whatever it is, at least higher than their peer group. But whatever it is, it's not equity that's driving it like AbbVie. It's actually the amount of money that they're bringing home for their shareholders. Excuse me. Interest burden, the tax burdens, of course. You know, a lot of times, Pfizer's case of tax burden, 102%. A lot of times these companies, especially the seasoned ones, the ones that have been public for a number of years, they may be in a way at an advantage to get government contracts and things of that nature, along with tax credits that come with it because of the work that they do, or their work that the collaborative efforts that they have, say with agencies like the Center for Disease Control. So you have things, you do have some moving parts that play a part to that. Moving on to valuation data. Gilead Sciences, Pfizer, Merck, Amgen, and AbbVie. These are the 5 companies from this industry, and what I did with this was I took into account the qualitative data and the quantitative data from the previous slides. But for the most part, when people are evaluating companies, these are some of the major things that they look at. These are key indicators of where the company's value may be. So for the PE ratio, the price to earnings ratio, obviously we see Gilead at 8, lower than anybody else. So I'm looking at that as very key. If I give you $8, I'm going to expect to receive $1 for that, versus I have to give someone $21 in order to receive $1 back. That's very important as an investor to pay attention to. Price to book ratio, sometimes, you know, I highlighted AbbVie for being at 22 because they're a young company. They had their IPO in 2012, so they've made a lot of headway in a short amount of time. And for them to have a very high price to book is a very positive thing. However, I think over time, if they continue being a successful company, that will normalize a little bit and go down. Maybe not so much in the range as their peer group, but I expect that to go down in the future. Enterprise value to EBITDA, typically the lower that is, it could be an indicator as it being a company that may be undervalued and may be a good takeover target company. So we see Gilead with the lowest in the single digits, and everybody else in double digits. Moving on, EPS, Amgen again. Amgen's got the highest. Gilead is second, right behind that at 9. You have the more seasoned ones, Pfizer and Merck. They're not even hitting 3. AbbVie is almost at 5. So obviously we see Amgen is doing a pretty good job of the dollars per share that they're earning for their shareholders as well. And then times are just earned. This is somewhat a solvency ratio. How many times can you pay your interest payments before you probably need to go to your bank? 22 times for Gilead Sciences, Pfizer 10 times. So those are only two in the double digits. Obviously, Gilead's blowing everybody out of the water with that. So for these 5 valuation methods, obviously we see Gilead Sciences has 3 out of 5. To me, I'm picking Gilead Sciences as the best out of this peer group for biotech and pharmaceutical companies. Moving on to the next industry, we have the restaurant industry. We have Sonic, McDonald's, Starbucks, Yum Brands, and Papa John's. These companies are responsible for almost $300 billion of market capitalization and over $53 billion worth of revenue. The industry is at $466 billion of revenue, and the total market capitalization is 717 billion, excuse me. Now, if we think back to the biotech and pharmaceutical companies, their industry market cap was 770 trillion. These in the billions. So we see a huge disparity between market cap as well as revenue that these companies and these industries are going to be able to generate. Onto stock prices again. The purpose of this was to really try and find out if there were any trends. And we see there's a little bit of a trend going up from 2012 to 2015. And then we see a little bit of sporadicness from 2016 and into current 2017 so far. Of course, at the top we have McDonald's, very seasoned company. They've obviously been there for a long time. With the IPO, we see 1965 compared to the rest of the companies within this peer group who haven't existed before publicly before 1991. Current share price, Papa John's stands out in a major way at 178. That's a current share price around that range. McDonald's 169. I'm okay with McDonald's being at 169 because of how seasoned they are, because their 5-year average is over 100, and they've been doing this for a long time, and they're tested. They are tested within their industry, as opposed to Papa John's, whose 5-year average was $79, and they're sitting at 178. A lot of that, I think, could be attributed to the contract that they have with the NFL, and also, a lot of just perception of the pizza industry as a whole being very large. Another thing to point out is the beta for Sonic is 1.86. That's very high. So say the S&P 500 goes up $1, Sonic more than likely on average, with some standard deviations in there, is going to go up $1.86 for every dollar the S&P 500 goes up or down. But in a way, it works like leverage. It magnifies those gains and those losses. Moving forward to me, one of the more important slides, solvency management. Can you pay your debt short term and long term? In the short term, we see a huge spike from McDonald's from 2014 to 2016, but they're back within their peer group as of recent for cash. A lot of these companies, as we see, are pretty low on their cash ratio, so they're probably swimming in some debt here and there. And for the restaurant industry as a whole, we saw some sporadicness from 2016 to 2017, and that could mean trouble for this industry. Again, considering the fact that it's a smaller industry than biotech and pharmaceuticals, whenever trends hit for the restaurant industry, it's very important to pay close attention to it because it could spell a lot of trouble in the future. Looking at the debt to equity ratio, we can obviously see Pizza Hut for 2016 at least is well over, well over everybody else within the peer group. Sonic at one point was highly highly illiquid or insolvent. They were swimming again. They were swimming in a lot of money, but it wasn't their own. That's really bad. But they've since recovered, for 2016 fiscal year at least, and are back somewhat within a certain range, at least for this peer group. But you see Pizza Hut on the rise, as an outlier for debt. That's a lot of debt to be carrying compared to the equity. And as a shareholder, or someone who's a potential shareholder, that is a red flag to consider. Moving to supply chain analysis, Papa John's and Sonic have the least amount, which is, it's worrisome for Sonic, not so much for Papa John's. Papa John's pizza place, they need grains, they need tomatoes, they're gonna need cheese and some other ingredients that they can work the kinks out for. But for the most part, they don't need a whole lot of supplies. I'm sure that they're probably a company that locks in on some futures contracts. So for them, I'm not really concerned about the number of suppliers. Whereas McDonald's, they definitely need 86 suppliers because they're a global business. Next to Coca-Cola, they're probably the next most easily recognizable brand. So they would definitely need to make sure that they have all their measures covered, their T's crossed and their I's dotted, just in case, because again, you never know what can happen. Starbucks and Yum Brands on the rise with that as they continue to expand and try to reach for a larger share of the global market for the restaurant industry. Moving forward to the ROE, again, these are 5-year averages for the return on equity. So this is a DuPont analysis version of 5-step breakdown. As we see, Papa John's is leading with total asset turnover. Again, they don't have a lot of ingredients. They serve pizza pies. I call them pies in New York, but they serve pies. That's about it, and it's very cheap for them to make it. I'm sure they lock in on some contracts and futures here and there that allow them to really benefit from it. And over the 5-year average period, they've had a high total asset turnover. So moving forward to equity multiplier, we see the range for McDonald's, Starbucks, Yum Brands. These are at least McDonald's being more seasoned. We see them, floating around the same as Yum Brands, which is really good. They're not highly levered. Typically, anything over 10 for the equity multiplier, it could spell trouble. And we have 2 out of the 5 companies over 10. So Sonic and Papa John's, clearly we're going to look at and say, okay, these guys are outliers. But beyond that, they are potentially red flags as an investment because of how highly levered they are. Looking at the operating margin, we see McDonald's is the highest with $30. Everybody else is under 20, which is an indicator that, hey, whatever McDonald's return on equity is going to be, so far, that's what's driving it, as opposed to Sonic and Papa John's, whose debt and their leverage is what's been driving, or what we see is going to be the driver for their ROE return on the 5-year average. And again, interest burden and tax burden. Sometimes you have government things that allow some tax credits and things of that nature, which can be important, but for the most part, these are kind of sporadic, except for Yum Brands. They've had the most consistent, both with 8 and 9% for the interest and tax burden. But when we look at the 5-year average, 186 for Papa John's, 100 for Sonic. The 2 companies that are over the double-digit marker and then the triple-digit marker for the 5-year average ROE return, both of these companies' drivers for that is obviously their equity multiplier. Now that extra 80 over for Papa John's comes from their ability to actually turn their assets over into sales and bring more dollars. However, for them having such a high amount of leverage, it really makes it a little bit more unattractive. On to valuation data. Again, PE, ratio, price to earnings, price to book, or market to book as we call it, enterprise value to EBITDA, earnings per share, time interest earned. Some things I highlighted here was price to book. For Papa John's, the price to book is at 270.38. It's the highest out of its group. However, because of it being so high, I really think that it's overvalued, which you really shouldn't say that about a price to book, but I really think that the market is overvaluing it as of today relative to their books. And so I picked the second best for that, which was Sonic. Price to earnings, lowest again, Sonic. I give Sonic 20 bucks. I'm gonna get $1 back as opposed to giving up $26 to get $1 back. Again, Sonic's the best in that class. However, they're all floating within the $20 to $26 range, so they're not deviating from each other very much in that regard. Onto the enterprise EBITDA, we see not a lot of deviation for that either, but again, the lower the better in some ways, you can say, because Sonic may be a nice target takeover to consider in the future. So again, they're looking like they're the best company based on these. They've already got 3 out of 5. Earnings per share, moving on. McDonald's at $6. Everybody else is under 4. So they're obviously a lot more seasoned. They've probably been able to have enough time to manage some of the expenses and continue earning more per share for their shareholders. And looking at times that just earned 45 for Papa John's, that stood out to me, along with Starbucks right around 40. But for Papa John's, their times that just earned 45 to 92. The times that just earned is indicative of how many times can you pay your interest payments before you really have to go to the bank to figure out what you're going to do. So that measurement is really your interest over EBITDA. What we find with Papa John's is they're highly levered, as we recall from the average, from the debt to equity. We see they're highly levered. So for them to have a high times interest earned, but also have a lot of debt, to me that's a red flag right there. I'm confused there. Something's wrong here about this. And what it is for them and their earnings, they're earning a lot. Their costs are somewhat low, but because of the amount of debt that they've gone into, they have a lot to pay back. And all that 45 times that they can cover their interest, cool, but they're only bringing in $2.68 for their shareholders. Again, these numbers, they mean so much, but in the end, the big picture is, hey, are you guys able to create value? And from what we see, based on the amount of debt that they have incurred as of recent, they're not going to be in a very well position to create value. So obviously, based on this valuation data, we do have Sonic here having 3 out of the 5. So it appears that based on the valuation data, they should be the best. However, Sonic is just as levered, almost just as levered as Papa John's. They've experienced a lot of fluctuation. They have a lot of problems. They're going to have a lot of problems paying off their interest payments that they have, as we see. They're not earning a lot for their shareholders. So there's a lot of quantitative data that argues against them relative to their peer group. And because of that, as a risk-averse investor, I'm looking for something that I know, hey, they're probably going to be able to create value in the future. And McDonald's, hands down, between these, based on the valuation methods of quantitative data along with qualitative, McDonald's is the best one. So between these top choices, going back to Gilead Sciences and McDonald's, anything highlighted in green besides the company names, of course, means that that's an advantage for that company. And we see McDonald's is only beating them in 2 out of those 7, out of those 7 measurements we see there. So what I wanted to do really, between picking a company, was understand, at the end of the day, what's the goal of a business? The goal of a business is essentially to create value. You're creating value for your shareholders so that if you do go public, you can continue to go public because you're continuing to create value. The market's continuing to believe that you're going to be able to produce future cash flows that are positive. They believe you're going to be able to properly invest in net present value positive projects. And because of that, I wanted to look at the weighted average cost of capital along with the EVA spread. The economic value added spread is simply your return on invested capital minus your WACC. It's the difference between those two. And as long as it's positive, that means that the company that we're going to be looking at is creating value. So, looking at the EVA spread, it's kind of hard to see. The line isn't very thick, but they go up, they go down a little bit, but they always stay above 0, so they're always positive, although they are a little sporadic there. Pretty volatile, as we can see from the graph. If you can see it, it might be a little too dark. Economic value added, just looking over here, we see an EVA spread at 22%. 22% is very high. You know, that's an amazing number to think about relative to everything else. You know, we see a WACC of 7.5%, meaning if that company needs to go to a bank to borrow money, that's how much that is. All else equal, no premiums, anything else involved, a bank's going to charge them 7.5% to borrow, and they're going to charge them 7.5% to borrow, and so that's a very modest number relative to other companies who have weighted average cost of capital of over 8%. But the key thing is, are we creating value? And the answer is yes. At 22%, the spread or the difference between the return on invested capital and the weighted average cost of capital is very positive, and that's always a great thing. So for Gilead Sciences, they're at 22%. For McDonald's, they're at 15%. Again, both very positive. McDonald's has been positive the whole time. They've been volatile to an extent, however, they've been continually rising in a way similar to how stock prices should go. You'll go up, you might have your dividends, they'll go down a little bit, and then they'll continue to rise. So McDonald's here, their EVA spread has been similar to how anybody would really want their stock price to go. But as we can see, their weighted average cost of capital is 6.3%, a lot lower than Gilead's at 7.5%. But their return on invested capital is not as high as Gilead's. And again, as investors, we're looking for the least amount of risk for the greatest amount of return that we can get. The EVA spread's at 15, as opposed to Gilead's, which is around 22. And so, as a conclusion to this, I'm thinking, based on all of the quantitative as well as the qualitative data, that the best company to choose is going to be Gilead Sciences. This company has a lot of great prospects for the future, and I hope that anybody that's interested in investing will consider this company as a part of their portfolio, as long as they're not weighing their portfolio heavily in the biotech and pharmaceutical company, or industries rather, excuse me. But my name is Akil Brown, and I appreciate you for being with me, and that's my project.